Hello and welcome to NJ Biz Conversations. I'm your host, Jeff Kanige. My guest today is David Greek. He is the managing partner at Greek Real Estate Partners. David, welcome.
Thank you. Happy to be here.
Oh, great. I should also say we're talking on November 1st. On the Monday coming up here will be our Commercial Real Estate Power 50. David is on that list. Congratulations.
Very excited to be on the list again, and it's an honor. It's an honor to be on the list, actually.
Okay, well, that makes you a great person to talk about commercial real estate in New Jersey. So that's what we're going to do. First, I want to hear a little bit about the firm. I know it's been in business for decades, tens of millions of square feet in industrial properties and more than 1,000 projects. What is it about your firm that's different, that differentiates you from competitors?
Well, we've been in New Jersey for a very long time. My grandfather started the company in the 1930s, really as a contracting firm in Northern Jersey. Our first project was, a $500 porch on the back of a residential house. So we've grown a lot and changed a lot since then. We kind of grew into property development over the course of the 40s and 50s. My father joined the company in the late 60s after a short stint in the military. And really from my father's joining, we really started exclusively focusing on the industrial space. And that is still what we focus on to this day. So we remain a fully vertically integrated firm, which does set us apart from a lot of our peers in the state. We self-perform almost all of our own general contracting. We also have in-house design teams that help manage the entitlement process. And then after the buildings are complete, we have asset and property management in-house. So we manage about a 20 million square foot portfolio across New Jersey and Eastern Pennsylvania. And we remain really hyper local to this day. Even though we have a large presence here, we're very, I think, important to the development market in our region. We like to stay close to home and really operate in markets where we have a presence and where we understand the market dynamics and the politics, and are able to really build it ourselves. So generally speaking, we're based out of East Brunswick, New Jersey. About a 2 or 3 hour radius by drive around that is the markets where we operate, and we build exclusively industrial. So manufacturing, distribution centers, data centers, anything that falls within the industrial bucket is our focus here.
All right, very good. So that's it's an interesting interesting market. There's been a lot happening in the industrial market in New Jersey over the past few years. I just in general, what's your assessment of the state of the market now? It's been very hot. There's been a lot of activity. Has that been sustained? Is that still going on? Where are you now, in the industrial market in particular?
I'll start from a 50-year perspective and then zoom in very quickly. So from a 50-year perspective, New Jersey industrial, the region's industrial is doing fantastically. There's historic levels of demand. There's less supply in comparison to that demand than we've had historically, and rents are still growing at a very healthy pace.
Good.
From a much more shorter term perspective, we had a really, really large run up in industrial values and industrial rents over the last decade. Right. And if you measure this year as compared to the last 3 or 4, this year's activity is down. The capital markets are in so much disarray that it is causing some value declines within the industrial space, some hesitancy from our tenants to commit to large capital projects or large new leases. So things have slowed down in the short term relative to the last couple of years. I think it's important for everyone to remember that, in a longer historical context, this is still a very favorable market to landlords. This is still a great area to invest. And it is mostly what is causing the slowdown is mostly external factors that are not necessarily driven by our tenants or our uses in the industrial space. It is, like I mentioned, the capital markets play a huge role in every part of real estate, not just industrial. So until we have some more clarity and some more stability in the capital markets, the market will probably remain a little slow compared to the last couple of years. The general consensus within the industry, and I agree with this, is that almost as soon as we get some stability from capital markets, that there will be a big resurgence in industrial demand, and we will go back to say 2019, 2020 levels of tenant demand.
Okay. Now that's instability in the capital markets. Is that a function of higher interest rates, or interest rates moving, or what's causing that instability, that uncertainty?
I think interest rates are the main driver. Obviously, there's been a historic run up in interest rates. It happened extremely quickly. Can't say it wasn't something we could have foreseen, but the pace at which it happened and the extent to which it grew, I think was very hard to predict. So that has had some unforeseen effects on values. And debt is an extremely important part of real estate in general. So
Sure.
whenever the cost of debt moves, it's always going to impact the cost of real estate. So that's certainly had an impact. I think it's not just the cost of debt as well, it's also the availability of it. So particularly within the construction space, there's a lot less construction lenders this year than there was the year previously. And those that are lending have smaller buckets of money in which they can lend. So the ability to get construction financing, there's limited liquidity there. And that is, in some ways, again, if you look at a longer term outlook here, that's not necessarily a bad thing for the overall market. Because as we're seeing this slowdown in tenant demand, we're also seeing a slowdown in construction. And that should help really rebalance the supply demand much more quickly than it would if construction debt was still readily available right now.
Okay, all right. Well, so the availability, that's an interesting point, because when I've asked other folks like you, your peers, colleagues, about higher interest rates, the answer I get is yes, it's a problem, but in historic terms, the rates aren't terribly high right now. Still, I mean, if you take the long view, but it's interesting to hear you say that the availability is a problem simply because there aren't as many lenders out there now.
That's right. And you're absolutely right about your points with the interest rates historically. We are not in a high interest rate environment historically. Right. We're in a high interest rate environment for the last 10 years, but take a longer term outlook, and we're back to average, basically, over historical average. So and when we're looking at new projects, generally speaking, it's not the cost of debt that is keeping us from moving forward or keeping us from being competitive, because the entire industry is facing the same issue there. So it's not impacting our individual companies' competitiveness in the market as much as it is impacting the entire market overall and slowing it down.
And is that also impacting tenant demand? You mentioned that demand had pulled back a little bit. Is that really where that's coming from too? Is that same dynamic having on tenants rather than just on firms like yours?
More or less. I think it's less direct with tenants. They're less directly impacted by the cost of debt. But if you look at the corporate bond market, the cost of their debt has increased significantly as well. From what we've heard, and we've had a lot of conversations with our tenants and listened to a lot of our peers' conversations with their tenants, there's a general nervousness within corporate boardrooms today, and a nervousness to make big decisions. Now, what gives me comfort in the long term is that especially the big companies, still know that there's a lot of work to be done in terms of building out and fixing their supply chains and building them out to fit the modern form of consumption, which is e-commerce, as well as catch up with some of the major distribution trends we saw emerge during COVID, like keeping more inventory on hand than you need in order to work through these exogenous supply shocks. So there's a lot of demand that should be coming, will be coming. And this gives me a lot of confidence in that future when capital markets start to stabilize. There's an acknowledgement from all of our major tenants in the space that they're going to continue to need to grow. It's the reluctance to actually just make that capital investment today. If there's an option to outsource those, they're taking it. So this is actually very interesting. If you look at what tenant demand has been, who is in the market, what types of tenants are in the market, it's almost entirely third-party logistics companies this year.
Okay.
And that tells me a lot about, big companies need more distribution, need to work on their logistics, but they're making a decision to do so by using a third-party logistics company, which is not on their balance sheet. So it's less risky for them. Ultimately, it's more expensive in the short term for them to do that, and they know that. They will correct that in the future. But while there's so much uncertainty in the world, they'd rather take less risk and keep it off their balance sheet. And that's what we're seeing directly in the tenant demand market today.
Okay. Okay. Well, you touched on something I did want to ask you about, and that was some of the changes that had taken place in the commercial real estate market, in the industrial space, in logistics. Part of it, much of it, predated the pandemic, but the pandemic seemed to kind of accelerate some of that evolution. The question I was going to ask you was, are those changes permanent? What I hear you saying is, yes, those changes are permanent. That kind of demand for those kinds of projects is still exists and will exist in the future.
Absolutely. And look, COVID is a very complicated topic, and I'm sure you could do a whole 20-30 minute segment just on the impacts of COVID.
Indeed.
Some of those impacts were short term. There, one of the impacts was durable goods. A lot of people were buying home goods, for example, during COVID. And if you look at the demand trends this year, the demand for home goods has gone way down, because for the most part, if you needed a new refrigerator, you needed a new washer dryer, you replaced it while you were at home, while you couldn't go into the office. You had some, most Americans had some extra cash to spend because they got some stimulus money from the government, or they didn't lose their white collar job. That trend, the demand trends have reversed to now be much more service heavy, right? So that's not necessarily a great thing for our industry, for industrial, where we're distributing primarily goods out of our warehouses.
Right.
That will correct itself. That's a cyclical piece of this. The shift from consuming goods in brick and mortar stores to consuming goods online, that is a longer term trend. And what COVID did was to accelerate that trend very, very quickly. So by some measures, we got about 7 or 8 years of e-commerce growth within about a 2-year period during COVID.
Oh, okay.
And if you look at the stats right now, that looks very, very sticky. It doesn't look like that is going to go back down. We're simply going to be jumping ahead of the curve of what we thought 5 years ago in terms of where e-commerce demand is. So we've gained a lot of new customers in the e-commerce space that are not going away. Now you could spend a long time talking about this. There's winners and losers there, right? Grocery was a big component. A lot of people were talking about e-commerce grocery. That doesn't seem to be moving as quickly as people thought it would. So it's not, you can't apply this to every piece of the e-commerce equation.
Sure.
But the macro story is that this demand trend is not going away, that the users gained during COVID are generally going to stay an e-commerce buyer.
Okay. Now, I'm curious though, what sort of challenges you see now? I mean, when I talk to, again, your peers, the complaint I hear all the time is how difficult it is to get to build things in New Jersey. Permitting and approval process can take forever. It's extraordinarily time consuming. I wonder how big of an impediment you find those kinds of regulations to be, and how you measure the effects and work around them.
It's a huge impediment and a huge expense. And in some ways, it is not a terrible thing for investors in industrial space in our market, because it really helps control the supply of industrial space. It takes a lot longer and a lot more investment from a developer to be able to build industrial in our state compared to even our neighboring state, Pennsylvania. But if you look across, the broader nation, New Jersey is considered the most difficult state. Sometimes we tie with California, but it's really considered one of the most difficult, one of the most expensive places to develop in the country.
Right.
And regulations has a big component to that. The other component is that we're also the densest populated state in the country, one of the oldest states in the country. So almost all of our projects today are a redevelopment. It involves taking land that's already been in production for many years and rebuilding it basically to make it more modern, or change the use to something that there is demand for today. So that again, that helps control the supply of industrial space in the market. And if you look to broader national trends, the reason the industrial market almost always gets in trouble is because of oversupply.
Okay.
And if you compare industrial to any other real estate asset class, you realize that the actual construction of an industrial building happens pretty quickly compared to an office or a multifamily asset. We can start from shovel in the ground to a shell complete building for almost any project within 12 months. And that means in a market where there's not a whole lot of entitlement risk, where it might take 2 or 3 months from when you buy a property to be able to put a shovel in the ground, you can react to spikes in demand by building more industrial. We can't do that in our state because it's extremely hard to find sites because
Right.
we're so dense. And the process for entitlement takes anywhere between a year and 3 years, depending on how many different government agencies need to weigh in on your plan.
Okay.
So responding to demand in real time does not happen here. We build industrial as we can, which is very slow compared to other states in the nation. And that has really helped drive rents here. And you know, if you look at, you know, the time to entitle sites and put that graph right next to a rent growth graph, I think you're going to see a correlation there.
Okay.
That has helped New Jersey be one of the strongest rent growth markets in the country. For someone who develops like myself, it gives me a lot of extra gray hairs. It makes my job much more difficult. It makes the risk we take on when we develop much riskier. So the financial part of our job gets tougher. So all of these things are not quote unquote good for development, but they are good for the value of the assets in the long term.
Okay. All right. It's interesting that you say that a lot of what you do is redevelopment, because there had been a sort of a backlash to some of the industrial the proliferation of industrial projects, big warehouses, towns unhappy with truck traffic and things like that. But what I hear you saying is that you know, if a property already exists and was being used in that way before, you kind of get around that. Is that right?
Not always. I'd say, you know, there's
Okay.
a public comment period basically to every application that we do. And, you know, even if we are redeveloping something, we always have to work with the surrounding communities to make sure that we are, you know, we are being welcomed in and that our plan is not going to cause so much commotion that we won't get approved. So you hit on some of the major things that we have to touch on every application. Traffic has been, you know, a real major driver of these applications and the concern from the public for a while, along with environmental. Environmental is something, you know, in a redevelopment project in our state. New Jersey has some of the toughest environmental regulations in the country. And we also have some, you know, some of the most contaminated sites in the country as well. So
Right.
Put those two together, and you know, we spend a lot of time focusing on environmental remediation, especially on the sites that we are building, and that requires, you know, a lot of communication with the public to explain what we're doing, and make sure that they feel included and feel safe in that process while we're doing it. So that adds a lot of time and expense to the overall redevelopment process. But you know, there's certainly been some pushback that has been unmerited within the industrial space. You know, simply what we in the industry call NIMBYism, not in my
Right.
backyard,
Right.
where people simply don't want to be co-located next to an industrial facility because of the connotations that come with it. I will say, we push back on that often by showing people what we actually build today and showing them the types of uses that go into those buildings. That has been one of the biggest changes over the last 10, 15 years, especially as e-commerce has grown into one of the largest tenants in the space. The amenities for employees inside these buildings are much better than what they used to be. You know, they pay attention to stuff like natural light and creating appropriate break rooms and giving some outside space for the employees to be able to go out and have a picnic in the summertime. And these might sound like small items to you know, those of us used to working in a white collar office environment, but you know, these are big improvements in quality of life for these people, as well as the fact that these facilities can now employ thousands, not
Right.
just hundreds of people.
Yeah.
So these are, you know, these facilities are really good for the communities. They bring a lot of jobs in. They bring a form of tax revenue that townships really, really like, because we are not adding burden to their infrastructure in terms of their schools. We're simply adding jobs and adding property tax revenue and creating, bringing industries to these towns. And especially when we're talking in the context of redevelopment, right? We're often taking sites that are very challenging from an environmental perspective, or maybe have sat fallow for a long time because there was too much expense to demolish and repurpose the property. I know this is a bit self-centered, but I do see the work that we're doing as really a good thing for the communities overall. And of course, we do projects because we like to make money in real estate, not as a amenity to our surrounding communities. But I do think a lot of the work that we do ends up benefiting these communities in massive ways. We don't often get credit for that work, but it is important work, and it's doing a lot of good for the state.
Of course. Okay. All right. Well, you've been very generous with time. Before I let you go, I wanted to get a little sense of what you think the market is going to look like over the next, through the end of this year and into next year. I know you said you figured you thought demand was going to come back. Do you have any sense of a timing on that? I mean, what are you planning for over the next 12 months?
Wish I had a better sense of timing for that. But I can tell you what I'm thinking, and I'll tell you, before I tell you what I'm thinking, I'll tell you, I change what I'm thinking about once a week. So if we have this interview next week, I might give you a totally different answer. There's a lot of interesting data out there, and it's all telling slightly different stories. The consensus right now, I think, within the industry is that we expect demand to kind of remain at this level, if not grow slightly over the next 6 or 8 months. And we expect around next summertime there to be a little bit more stability in the capital markets, there to be a little bit more reassurance from our corporate tenants that it's time to start growing again. And the third thing is that there will be, most of the supply on the market today will have been soaked up, and there'll be very little supply at that time as well. So that is really, we're looking towards the back half of next year as to when this market kind of reaches a full recovery point and starts really humming again. But I can tell you that could be a lot sooner, and it could be, a year later than we predict. So as we do with all of our projects, we tend to be very conservatively capitalized, and we will remain conservatively capitalized until, the future looks a little more clear for us.
Okay. Well, I hope you come back and give us whatever answer you have at that point.
Let's see what happens.
I'd love to get an update and see how your thinking has changed. That'd be great.
Sounds good.
Okay. David Greek, Managing Partner at Greek Real Estate Partners. Thank you very much for joining me. I appreciate you taking the time.
Thank you, Jeffrey.
And thank you all for watching. Until next time, stay safe, everyone.